In this presentation, we will take a look at our overall strategy for entering cash outflows from our checking account by taking those outflows from our bank statement and entering them directly into the check register within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. We are in our mock bank statement. The last time we had entered the deposits and the beginning balances. Now we're going to be considering the check side of things, or the outflows within our bank statement, and how to get those into our QuickBooks system. So we have the beginning balance taken care of, all the deposits. So in essence, we found this information so far. We're now moving on to this item, which are going to be anything that is an outflow. Now, outflows are a little bit more difficult in that there's a lot of different areas where outflows are going to be coming from. In other words, if we think about our assumptions for the deposits, we assumed that all the deposits are business related. We assumed all deposits are going to be from customers unless they are stated otherwise. And we had a couple questions about these two items. On the withdrawal sides, or the outflows, we're going to have assumptions as well. One, that all of the outflows are going to be business related. Now, unlike the deposits, it might be a little bit more tricky for the outflows, because there might be some information, even if we have ourselves or our clients who are very good at separating their checking account on their business and personal, which hopefully that would be the first thing we would want to do, is have a separate checking account for the business. But even then, there could be items where, there's going to be items that are out of the business checking account, which might be personal items. And we're going to have to take a look at that. Now, if there's a lot of items that are outflows from the business checking account that are personal, then we're going to have to deal with that somehow. We'll talk about how to deal with that. But the ideal system would be to limit those items, because especially if this is our own books, then we'll be able to kind of recognize that a little bit more easily. But if we're a bookkeeper, then it's going to be difficult for us to recognize those types of outflows that are personal and not business. If we do recognize them, then we can deal with them and we can figure them out. So it's not the end of the world. If there's some mixing up, we'll talk about how to deal with that. But our overall assumption is going to be that anything that's an outflow is business related. It's a business type of thing. And therefore, we'll be able to deal with it on a business side of things. That's the first assumption that we're going to make. Now, we cannot make the second type of assumption that we made over here, that they're all going to be the same type of account, meaning these are all going to be sales items, typically from customers. Over here, we're going to think that they're all vendors, meaning they're all people that we pay for business purposes, but that we can't group them all into one account. That's going to be the problem. We've got to break out, they're all expenses typically, expense type of accounts, but we don't just have one expense account like we have one sales account over here for the type of income. Over here, we're going to have to break it out to different types of expense accounts based on what we used for it. And now QuickBooks is helpful because it gives us those line items that we can then group these up. So we're going to now have to think about this and say, all right, we have vendor information typically. If they're checks, we're going to have vendor information. If we have electronic transfers, which is possibly the case a lot for many customers, they might be doing a lot of electronic transfers directly out of the bank account, then we'll typically have that information as well, because they'll give us information about the vendor who was paid. And so that's fine. So notice we have check numbers here. It doesn't really matter. This is just the example. If we had electronic transfers, we might even have more detail. They might give us more detail than just like a name that would be on the check. If we have checks, then we need to see basically the canceled check. So we're going to have a date, we're going to have a check number, we're going to need to have the canceled check, meaning who they wrote the check to, so that we can then determine the vendor who it was written to, and that then we'll use to help us determine which account we're going to select. Should it be the phone bill? Should it be utilities and whatnot? So we're going to have to go through these. It's going to be the added challenge of the expenses and determine which accounts these should go to. And once we do this for the first month, it's going to be a little bit more difficult because we don't know these vendors. If we're a bookkeeper, we don't know them directly. Even if it's our own business, we're going to have to assign the vendor to a account. Now, once we've done that for the first time, it'll be easier to do for the second month because accounting is cyclical. So the first time we do this, it's going to be a little bit more difficult. Note that even if we had bank feeds and we did this automatically and entered this data in from bank feeds, we'd still have to figure this out, this type of problem, like which vendor goes to which account. So we're going to have to do this no matter what. We're going to have to figure this out, and no matter what, the second month of data entry will be easier because the system will know more about these deposits and where they should go. So for example, we'll take a look at the first one and say, well, who is that? And we'll enter it into the system as a decrease. Look for the expense account. Now, if I don't recognize Epiphone because I'm a bookkeeper, then I'll have to think about that. If I'm the customer or this is my business, then I probably know who that is, but I still might not know which expense account it should go to. I might be asking an accountant or something. Then I'll write that down just like we did before, take notes on it, and then go ask questions. Gibson, same thing. Safe Insurance Company, looks like some type of insurance expense that we'll have to determine. Staples looks like some type of supplies. So when we have that, we'll enter the supplies possibly. It's a big dollar amount though on this one, or this is insurance. So we have the Edison, that sounds like the phone or the electric company. So we can figure out some kind of electric expense or something like that, or utilities. And then we'll go to the Office Depot, and that sounds like office supplies maybe, but it's a fairly big dollar amount. So maybe there's something different. Maybe that when we see that big dollar amount, we might have a question about that. Vanguard Investments, big dollar amount, we might have a question. So we might have some questions, obviously the Verizon, the phone company. So we might have some questions when we enter this. We're just going to power through it the same way we did before. We're going to assign the expense accounts we can, list the questions that we have questions about, and then ask either the client or our accountant about those questions, going back, making adjustments at a later time. Once we have those questions all answered, we can answer them all at one time, hopefully, one list of questions instead of multiple emails and whatnot. And we'll do that. That'll be the strategy as we enter all the withdrawals. Once we enter everything that goes out of the bank account, whether it be a check, electronic transfer, bank charges, and things like that, then we will have taken care of this number, and our ending balance should tie out to this. It should tie out exactly to what's on the bank statement. Now, it's not in our example because we're going to purposely make errors and maybe unpurposely make errors, and then we're going to find those when we do the bank reconciliation process. So if there's data input errors, which I'm going to do some on purpose, then that's okay because we're just going to put this in as quickly as possible and then do the bank reconciliation, and that'll help us to find any errors, any problem. Also note that we have a similar timing issue that we had with the deposit side, but it's not something that small businesses is as big a problem for many small businesses. To take a look at that, let's go back to our information here. This is QuickBooks. We're going to go back to our data on the plus side and look at the vendor's normal cycle, the full cycle. But to do that, we're going to go back to the desktop version again because it'll give us that pictorial view. So this is the desktop version, not the online version, but it gives us this pictorial view. So here's going to be our vendors. That's what we're concentrating on now. These are people we pay. Now, typically, if you think about vendors and you think of it on an accrual system, then ideally we would be taking the bills every time we get a bill, utility bill or phone bill or any bill for buying things, inventory and whatnot, whatever, we would enter the bill when we get it because that's closer to the point in time that we actually got the service, the work happened. In other words, if we had the phone bill, we would enter it when we get the phone bill, even though we might not pay it for another 30 days. And that means it would go into the system as an expense closer to the time we actually consumed the use of the phone, which is more proper, and we would record the liability at that point in time as well. And then when we pay it at a later point, we would pay off that bill with a check. And once we pay it with a check, then it would just decrease the payable, the liability that we would have. So that's the typical flow. Now, of course, here we're not doing that because we're just going right to when it clears the bank. We're going right to when it clears the bank, or we're waiting till it clears the bank. We're not entering the bills as they happen. In other words, we're waiting until they clear the bank and then recording it. Now, so that means we're not going to have an accounts payable account because that's an accrual account, not a cash basis account. So we're not going to be tracking bills that are outstanding. So if the customer needs that, the tracking of the bills outstanding, they're going to have to do that outside the system, or they're going to have to, or we can make some accommodations for that and vary our system. Now, normally this isn't as big a deal as tracking accounts receivable. Many small businesses really need to track accounts receivable, and are really concerned, of course, with getting receiving of payments. And then bills like the utility bill and whatnot, they're more than usually fine with being able to not track that and just pay them at the end of the month, and then record it on the bank statement and just record it as they're being paid. So many times small businesses are okay with not having an accounts payable, in other words, but are more concerned possibly with tracking the receivables. So this isn't as much of an issue. Now, it is an issue sometimes that businesses will use credit cards, and the credit cards become an issue. When they start buying something with a credit card, we have a similar issue in that we have a liability that's not going to clear the bank because we're not going to write a check until some future time. We're paying off the liability short payments. So that's an issue that a small business has that varies from our normal system as well, and we'll talk about that. We'll see the credit card payments hitting the bank statements, but if they're not paying off the full credit card, then we're going to have to think about, okay, that's an issue. They'll have to deal with that. But the accounts payable itself, not usually as big a problem for small businesses as maybe the receivable could be. But we want to be aware of it so we can explain it to the client and or ourselves what the difference is between a cash basis and accrual basis. So if we go back to the online version then, and we go up to the plus item up here, notice we go to the plus item. In the vendor section, this is usually where we enter kind of the forms. And we're not going to be entering forms, we're going to be going directly into the register for most of our transactions. So typically we would enter a bill and then we would pay the bill, and that would take it into accounts payable and then pay accounts payable. We're not going to do that. We're in essence going straight to the check or straight to the expense, and we're typically going to do that not by these input screens, but by going directly over to the accounting, directly into the chart of accounts and the register. We'll be entering right into the register, the most direct method for the data input, as we did with the deposits. For more accounting information and accounting courses, visit our website at accountinginstruction.info.